Hey, everybody. We're going to start today's report off with Tesla and the latest drama or troubles with Tesla. Now, overall, Tesla has been very successful. And I know people here in California that bought a Tesla and they're perfectly happy with it. But the cold weather and sub freezing temperatures have really created some problems. Let's take a look at what's happening up in Chicago. Let's take a listen here.
Okay, Emily, thank you. That cold is also causing some big time headaches for Chicago area owners of electric vehicles.
Yes, I never thought we'd say this, but it's true. As Dane Placco reports, the low temperatures have caused some headaches for owners looking to charge their cars.
Electric cars may be the way of the future, but it's clear there are some problems when it comes to charging them in Chicago's deep freeze.
Oh, we got a bunch of dead robots out here.
Dead robots. Dead Teslas packed the parking lot at this Tesla supercharging station in Oak Brook, a scene mirrored in other supercharging stations around the Chicago area.
Man, this is crazy. It's a disaster, seriously.
With temperatures falling into the negative double digits, these charging ports have stopped charging, leaving many Tesla owners stranded here in long lines since Sunday.
It's crazy. Wow, these are problems that people really didn't see coming. Now it's been very, very cold this winter. You might make the case, well, these people didn't do their homework. They didn't see, what the problems were going to be with Tesla. But that's anytime you have something new, and it actually is not new. I mean, Tesla's been putting out vehicles since about 2008, just going off of memory. And, this is a big problem. And the reason I wanted to bring this up here, because of course we're a financial channel and automobiles and vehicles are the second biggest purchase most people will make in their life, behind, of course, homes and real estate. So it's very big. And these problems, people can't get to work, people can't go do their things because they can't charge their vehicles. And it's different than hybrids. Hybrids, you still have the option of going to gas or fuel. And we're starting to see a reversal now of the whole going green thing. We're going to talk about that here in just a few minutes. We're talking about the current administration, the amount of oil that we're pumping, and we're going to get into that here because it's very important. But first of all, what do you think about these Tesla problems? Is this going to be another big thorn in the side, so to speak, of Tesla? Well, I think so. And especially with these freezing temperatures, nobody wants to be stranded and not able to charge your vehicle. Now, what we found out from these reports, it was more about the charging facilities than it was the actual Tesla vehicle. So hopefully they'll get these charging facilities sorted out so Tesla owners can, get to where they need to go here. Well, let's talk about this. We were supposed to be moving away from gas and fuel and fossil fuels, etc. Here we are now. Surging U.S. oil production may set a record in 2024, shielding consumers from Mideast war and pressuring OPEC. So we heard that we're going to stop production of oil. They actually did almost completely stop it for a while. Prices surged. Now everything that's happening with the wars and the supply chains, we've ramping oil production back up here in the U.S. In fact, we may set a record. So just the opposite of what the current administration said they were going to do just a few years ago. We were supposed to move away from these from fuel, from gas, and a big push towards electric vehicles. We had government incentives to buy a vehicle, to buy an electric vehicle. Now we're seeing a shift back, and could it just be because this is 2024 and we have a selection year in November coming up here, and they're just trying to keep prices of fuel suppressed in the meantime, and then after that they're going to go ahead and stop production again or decrease production of oil. I mean, it's going to be very interesting to see how this plays out, but record-setting oil production, in my opinion, is to try to keep prices tamped down because they see inflation across the board and they see how much trouble consumers are in. Speaking of consumers in trouble, we know, if you're on this channel, then you know one of the main things keeping the economy chugging along and keeping us out of a recession slash depression is people's ability to take on more and more and more debt. Once people can no longer go further into debt, this whole house of cards economy comes crashing down. So naturally, what do they need to do? They need to keep on raising the limits of credit cards. And what do we see here recently? Another record in credit card spending here. And we just set another record here as of December. Credit card debt out of ABC here. Credit card debt reaches record high in U.S. Americans' combined credit card balances topped $1 trillion last year. Americans' combined credit card balances over $1 trillion. By comparison, debt was $680 billion a decade ago. So not quite double, but it's getting close to doubling. Also, the number of Americans missing payments has also increased, with the average credit card balance now standing at $6,000. All right, there's some other numbers I want to get to here. Credit card delinquencies are rising the fastest out of lower income borrowers, of course. Millennials and people who hold other kinds of debt, especially the people that are holding student loan debt. We see almost half of the student loan debtors or payees are not able to make their payments on time. Let's see what else here. And with the current interest rates, a credit card user with a balance of $5,000 is going to pay $7,000 in interest. So they're going to pay more than they borrowed if they just make the minimum payment. The big problem is a lot of these people with this debt, especially younger people, are not able to even make the minimum payment, as we see delinquencies really start to go up. So you would think that banks, credit card issuers would be more cautious about who they give credit cards to, but they're actually not. And that's the key to this whole thing. If people can continue to go further into debt, even with delinquencies, you're going to see this economy really go on much longer than most people expected before we see some big economic correction. This entire economic boom that we've witnessed over the past 10, 12, 13 years has been driven on consumption and accumulation of debt and the issuance of loans and credit. So, of course, that goes hand in hand with what we saw here recently, how the markets jumped at the talk of rate cuts in 2024. What do rate cuts do? What do rate cuts do? They make it easier to borrow money, more consumption, more debt accumulation, and therefore asset prices going up, including the stock market, right? So we see companies borrowing money, going into debt, businesses borrowing money and buying back their own stock. That's one big driver. And of course, the insiders cash out. The upper level executives, CEOs, they cash out with their inside purchases and their stock options, and they make off like bandits. So of course, lower interest rates is going to drive the markets higher. So easy money, lower interest rates, driving markets higher. Just the talk of lower interest rates driving markets higher. But the central banks out there trying to reverse some of the optimism and eagerness for these rate cuts. The Fed is sending out a new message on rate cuts. Is Wall Street listening? So they're now trying to make it sound like there's not going to be very big rate cuts, and these rate cuts may not come as soon as some investors want them. The Fed's Logan pumps the brakes on quantitative tightening. This also goes with rate cuts, because when the Fed's unwinding their balance sheet and selling off assets, that puts upward pressure on rates, especially mortgage rates. When they're doing quantitative easing, meaning they're buying assets, that puts downward pressure on rates, right? So it's all about rates, it's all about easy money, the ability for people to borrow money, companies to borrow money, go further and deeper into debt. Now let's jump over into real estate real quick. Most of you know we keep a very close eye on the housing market and in real estate in general. As the real estate market goes, typically goes the economy. Now sales have been very slow because inventory is low. Mortgage rates are high compared to just a couple years ago. From a historical standard, though, rates are not that high. A 6%, 7% mortgage is not that high when you look at the big picture going back, decades and decades. But right now, we're still not seeing a big surge in inventory like you would expect to see for a housing market that's on the decline, right? So until we see inventory spike, we're likely not going to see much of a housing correction. You may see small price corrections like we have seen over the past couple years, but very small. In fact, the inventory numbers are out. And when we compare this to the housing bubble going bust in 2008, take a look at the numbers here. The housing market inventory hit 4 million before going bust in 2008 for the crash. We're nowhere close to that now. And this is out of Fast Company. And they give us a chart here of the current inventory. And let's take a look here. We see it's highlighted as of November, so just within the last couple months. We see New listings are down compared to most of the years previously, except for 2022. But when we look at inventory, it's right above this here. And what do we see as of September, just in the past few months here, we are under 700,000. Under 700,000. And we had 4 million homes hit the market back before the previous housing bubble went bust. So obviously we're still a long ways from the housing bubble going bust. And I'm not saying prices are going to go up. I'm going to say we are going to see further price corrections to the downside, but they're going to be very gradual, very small, unless something big happens where the entire debt market implodes and banks can no longer loan out money. There are people out there saying that that is going to happen at some point, that just boom, you wake up overnight, maybe on a Monday morning, another Black Monday, and you see the markets implode as a string of bank failures occur. Could that happen anytime? Absolutely. Do I think they're trying to allow that or to make that not happen? Are they trying to prevent that from happening? Absolutely. I think so. So it's going to take something big, something massive to derail the markets and to derail the debt markets, and therefore bring these bubbles, bring the markets down in real estate and burst these bubbles, right? So we're seeing inventory less than 1 million. It was 4 million before the housing bubble. So there you go. The numbers speak for themselves. What do you guys think about this report? Please give us a like, subscribe if you like what we talk about here. We're always going to keep you on top of the most important financial, economic news, so you know where the markets are headed, so you can plan for these things financially. And when you know what's coming, it's very much easier to plan, right? So that's the whole point of this. Bad news or good news, whatever you think this is, please let me know down in the comments. And what do you get out of this report today? What do you think about the Tesla graveyard and the Arctic blast rendering these vehicles unchargeable? Very interesting times, folks. And the ramp up now in oil production to keep prices down, is that just temporary until November is past, November of this year? I'd like to know what you think down in comments. And of course, the housing market, the inventory less than 1 million compared to 4 million when the housing bubble went bust. That should be an eye opener. Hear from you down in the comments, people. Thanks for being here. Big love. Keep stacking. Bye for now. Peace.